All right. Hello, everybody. Welcome back to another episode of The Market Close. It is Wednesday, September 4th, 3:47 p.m. We are back, and we've got a lot of things that have changed, honestly, since the morning. Not only did stock prices change in terms of what we saw when I left at around 12:30, but we've got a bunch of new headlines that are very, very interesting in terms of what we're looking at here. And these headlines have implications on NVIDIA, on the broader AI sector, on Palantir, on tax policies that have come out. We've got some new JOLTS data I want to go through. We have a lot of different macro stuff that I want to talk about in addition to all the different headlines that we have going on. So thank you, everybody, for being here. A lot to discuss, a lot to get into. We do have C3 AI earnings after the bell. So that's one of the big companies that has earnings. C3 AI, $3-4 billion company, not really that big of a SaaS player, but it will be interesting to see if their AI momentum or their AI expertise has started to get more prominence because if Palantir is reaccelerating, you would imagine other AI plays like C3 AI would be accelerating as well. Are you still fasting, Amit? Yes, I am still fasting. So in the morning, I watched the video last night. I saw a guy do a 3-day fast. So in the morning, I said, you know what? I'm going to do a 3-day fast. I don't know if I'm going to last, but so far I'm lasting. I feel hungry, but it's not like burning desire of hunger. And what I learned is that after you get through the first 24 hours, then it's not hunger anymore. Like the first 24 hours are the worst, and then you just move on. So I'm spontaneous. I said, screw it. I want to do a 3-day fast. We'll see what happens. Hopefully I can get through at least one day. But yeah, I will let you guys know tomorrow morning if that fast lasted. But I feel great. I feel good. I feel energized and not feeling too deprived of food. All right. So S&P 500, 551, down about 0.17%. When I left, we were green. Now that I'm back, we're a little bit red. We were at 549, so we got a green candle going on right there. NVIDIA is at 105.9, down 2%. Look, I think it could be a lot worse. In the morning, it looked like this sucker was heading below $100. So the fact that it's only $100 or 105 is actually okay to me. I mean, at one point in the morning, we got to 110. 109.99 right there. So we were green for a little bit, and then we fell all the way back down to 107, got back up to 109, then came back down to 105.9 on the day. Affirm is down 3%. Bitcoin was at 58,000. Now it's at 57.9, basically at that 58,000 level, but it did come down a little bit. Apple's down on the day. Tesla remained very green on the day at 219. Palantir fell below 30. Now right back at 30.50. It does feel like 30 is the new 20 for Palantir. 30 is the magnet that we are staying at. If we end this week at 30, it'll be 5 weeks in a row. 5 weeks, more than a month of Palantir being at $30, which will be absolutely exceptional. Dix, we talked about Dix in the morning. They were down about 12%. Now they're only down 5%. So you saw a little bit of recovery there. QQQ basically flat on the day. Affirm down 4%. SoFi, we'll talk about them. Noto was on CNBC today. I thought he absolutely crushed it in his interview. We watched it at the end of the market open. Right now they're down about 0.5% on the day. Zscaler, that story has not worked out too well today, down about 18%. Palo Alto down 2.4%. Kava's up 1%. IWM is basically flat on the day. Airbnb is flat on the day. Carnival Cruise down about 1%. TQQQ, again, also flat on the day. One of the big movers outside of NVIDIA today is Celsius, and this has only been to the downside. I think there was some bad news that came out about Celsius, but I don't really know what the news is. So if anyone knows, let me know in the chat. I haven't really been able to see the headline. I don't think it's something to do with sales. I think it's something to do with health. Again, I could be wrong here, but just a disgusting pattern here. We did say in the morning, if it breaks 35, it looks like it can go under 30. Now it's holding 32.28. So after it broke 35 in the morning, when I left, it was at 35.50 at 11:30 or 12:30. Now it's at 32.20. So we'll see if that can continue to hold up there. For those asking if I'm buying the dip on Celsius, the answer is no. I first of all, I just never liked the energy drinks. Second of all, there's so many other opportunities than energy drinks that are exciting to me. But for those that do believe there's a massive moat here, now, if you liked it at 50, I would imagine at 32, it gets more attractive. As long as nothing in the thesis changed, then, that's theoretically on any stock. You continue to buy the dip. The problem is I think some of the health side effects along with growth numbers maybe is changing a little bit of the thesis, probably not long-term, but at least in the short term. And so that's what you got to evaluate if you're thinking deeper about Celsius. NVIDIA right here. Let's see if we can close green. We got a nice green candle right there as we start the market close at 106.91. About $1 up would get NVIDIA to be green on the day. But right now, NVIDIA is relatively red. Jason will not be joining us today. He's going to join us tomorrow. He could not make it today or yesterday. So Jason, Technical Thursday, we'll have that tomorrow and go deeper on what we've got to do with all the technicals that we have. But he likes Celsius. I think he's probably buying more at this level, so he'll tell us more what he thinks. But he is more excited about Celsius. All right, so some couple of headlines that I want to talk about. We have a bunch of different things to get into after the bell in regards to the macro. I'm going to save some of that for after the bell because those are a little bit more nuanced topics that are going to take some time. But some headlines that I want to show that definitely caught my attention since the market opened, and I think it's going to be important to run through as we try to figure out what's going on with NVIDIA. So first of all, remember the guy who was part of OpenAI, Ilya, who was a co-founder of OpenAI? Well, he left Sam Altman a month ago, and he just started his new AI startup. We knew he had a new AI startup, but now we're like getting more details on it. Apparently, the dude raised $1 billion today. The company is called Safe Super Intelligence. Quote from the article or from the website. Safe Super Intelligence, SSI, is the most important technical problem of our time. We have started the world's first straight shot SSI lab with one goal and one product, a safe super intelligence. Okay, so here's my question to the chat, because I'm very curious what people think about this. Either you see a dude leave OpenAI, which just raised at $100 billion, is one of the most important AI companies on the planet, one could argue, and say, oh, that's bullish, because that means there's more money to go around. If this guy could raise $1 billion, rumors are the valuation is at $5 billion bucks. So he basically sold 20% of the company. That's bullish because there's so much money floating in AI. That's one perspective. I'm curious what you guys think. The second perspective is this is a bubble. This is ridiculous. This is like 2001. Why is a company with zero revenue, zero product? I mean, safe super intelligence. What the heck does that even mean? Zero kind of ideations outside of what they told the VCs they're going to do one day, gets to raise $1 billion freaking dollars in a pre-seed round of funding when they don't have anything they bring to the table other than the fact that the co-founder is the guy that came from OpenAI. What does it scream to you? Does it scream bubble, or does it scream money is flowing in AI? Because I think to me, it's a little bit of both. I think, okay, the fact that he could raise $1 billion, that's amazing because there's so much money floating for funding these AI ideas, which, by the way, I think that $1 billion is just going to go to NVIDIA. Like, if you're building some safe super intelligence, you need a lot of super safe GPUs. So, like, all that, I think that money is just going to NVIDIA. So I think from that perspective, there is a lot of money flowing in the system. But the other perspective is, well, what the heck is SSI? Do we even know what it's going to become? If it becomes nothing, why is this not pets.com raising a ton of money outside of it going public, just attaching a .com or attaching AI to it? I don't know. I think we're going to have to see how that plays out. But I think, there's a little bit of both on the bull and the bear side to that headline that definitely caught my attention today. Arnie says he is smart at exploiting people, giving him $1 billion. Yeah, I agree, dude. If someone's going to give me $1 billion after I leave one of the hottest startups on the planet called OpenAI, and I'm there to just start a new safe version of it, then I think that is definitely, it's definitely a hell of a risk that someone's taking. One other really key point on this is that why are people leaving OpenAI? We've talked about this for the past couple of weeks, but if people are leaving OpenAI to the point where they don't think OpenAI is building anything safe, to the point where they have to name their company Super Safe Intelligence, and then investors are willing to give them $1 billion bucks to like go like those investors could have just bought OpenAI shares at $100 billion. Now you may argue that funding a company at $5 billion is better than buying shares on the secondary market at $100 billion, but that company you're funding at $5 billion has nothing other than the co-founder from the guy who just came from a company that raised at $100 billion. So it's very confusing kind of how this is playing out. But that is one of the headlines today, and I think it has some implications for NVIDIA and the broader AI landscape. Another AI name, Palantir, one that we talk about a lot on the channel. Shout out to everyone who joined the market open. We had the head of energy, Matt Babin, with Arnie and I on Twitter Spaces. Got to talk to him. So we are officially getting a leverage long ETF for Palantir. It is going to be a 2x long ETF called PTIR. And that will be launching, I believe, in the next couple of days, if not tomorrow. So we're going to see if Palantir goes up 10%, PTIR will go up 20%. And this also was very interesting to me. Now, a couple of thoughts on this. First of all, the guy who runs this company, it's called Granite Shares. His name is Will. I will be having him on the channel probably next week, maybe even tomorrow, based on what we can work out. He is not the guy I was talking about in terms of that CEO that everyone knows their company, but they don't know who the CEO is. This is just a different guy. So he'll be on Honestly, if it launches tomorrow, I'll try to get him on tomorrow in the morning. But if not, then we'll get him on next week. So we're going to talk to him about leverage ETFs and what are leverage ETFs? What are the internal mechanics of them? Because I don't fully understand them other than knowing that this ETF does have to have a certain amount of exposure to the underlying asset. So it has to buy a certain amount of Palantir and sell a certain amount of Palantir every day based on the stock performance. But the actual mechanics of how they get it to algorithmically go double or triple the underlying asset, I think it'll be important to learn about this. Number two, this is good for Palantir in general because it just means there's more speculation. That means there's more money coming into the name. So that's like bullish. I can't say that's necessarily bearish. The one thing I will say here, and this is the answer that everyone has been asking on Twitter after I tweeted this, hey, Amit, are you buying this? The answer is no. I am not buying a 2x leverage ETF on Palantir. I would rather put that money into Palantir itself. Maybe there are very unique opportunistic moments where it would make sense to like trade a leverage ETF. But for the most part, I'm just not a fan of doing that. You know, like maybe Palantir drops 20% and there's a really good opportunity to sell some puts on it and there's some great premiums. And then I'll tell you guys if I do something like that. But in terms of actually allocating, you know, if I have another $5,000 I could put into Palantir into PTIR, I'm probably not going to be doing that. So leverage ETFs are very risky. You have to understand the risks of them. Underlying assets can go up or down aggressively, and that can hurt the ETF. NVDL is the biggest success story. This is the same company that is starting the Palantir leverage ETF. They are also doing NVDL. This thing has $6 billion assets under management. It's up 300% year to date because NVIDIA is up close to 150%. And it has been the most successful single stock ETF that's leveraged ever. It has more than 95% of most ETFs on the stock market. So I do think this will bring a lot more attention to Palantir. Do I think it's the healthiest? I'm kind of neutral. I don't think it's healthy or unhealthy. I think it's definitely bullish to me. It's not really bearish, but because there's just more money coming into the ecosystem. So that's not bearish. However, if Palantir falls 10 or 15%, the people that own that, you know, just like if NVIDIA falls 10 or 15% over the past couple of days, NVDL has been in a horrible situation. I mean, NVDL, we should look at over the past day. Yeah, look at this. Over the past 5 days, down 32% because NVIDIA is down about 15%. So one thing to keep in mind if you do engage in that product, but you know, in general, it should be bringing more money to the overall ecosystem for Palantir as well. This is Granite. The name of the company is Granite. It's not Direction. It's Granite. I don't even know if that's how you exactly say their name, but Granite shares. You guys can go to their website and also learn about the company, but we'll get the CEO. We'll get him on soon. And I want to ask him like a decent amount of questions on like, how do you actually mechanically program an ETF to go inverse or directionally 2x or 3x of the underlying assets. So we'll get his philosophy on it and get some more details on what this looks like. All right, we got 15 seconds until the market closes. We've got a lot of more stuff to talk about after the bell. We have a couple of earnings to go through, and then I have some macro data that I really want to discuss based on this JOLT report, because we got to break down what this means for the broader economy. Also, Citibank came out with some stuff, so we got to talk about them. And then we'll talk about the new Kamala Harris tax stuff that she put out today as well. 4 p.m. Wednesday, September 4th. Thank you, everybody, for being here. The stock market is now closed. All right, there we go. Done with the second trading day of September officially. So here we go. Palantir closes the day basically flat, kind of green, up about 7 cents, 0.23%, $30.58. It was below 30 at one point, so we got a nice reversal. SoFi ended the day down 0.5%. We'll talk about what Noto said on CNBC. Bitcoin doesn't end the day because there is no stop to Bitcoin, but right here at 58,000, up 2.44%. Tesla, great day. Their new ASS parking control thing seems to be getting the street excited. Also, we forgot to mention in the morning, Volkswagen. Again, I can't say their name right. You guys will make fun of me. I think it's them, or it's Volvo. It's one of those companies. Let me see if I can pull it up. They announced that they're not going electric anymore because they just can't compete. I'm going to get the exact name. Some of you guys might know the exact name of the company. It's one of them. It's Volvo. Volvo Cars scraps target to go fully electric by 2030. I don't know if Volvo is the same as Volkswagen. They might not be the same. But the point is, more EV or more companies are realizing, hey, we just can't compete with Tesla. And so that's another reason why Tesla might be up right now, along with the Chinese registrations. That was good yesterday. Apple down about 1% on the day. Dollar Tree took a nasty hit, down about 22%. I'm going to listen to their earnings call tonight and give you guys some more details tomorrow as we dive into it. But definitely that part of the consumer is not doing too well. Intel down 3%, Chewy down 3%, SMCI down 4.14%, S&P 500 I mean, it's down a little bit, but based on what we had yesterday, really not that bad. Robinhood, we do have some updates on Robinhood as well. We'll talk about that in a second. They're down 1.34% on the day. NVIDIA ends the day 1.67%. 1.67% at 106.2, down a little bit after hours. It was at 109 at one point, now down at 106. C3 AI, so they have earnings today. They are up 3%. Let me see if I can get their numbers real quick. That's the only company that really has earnings today after hours. And we'll see their numbers. Their number is not out yet, but we'll see how the market reacts. That GitLab had a great day. Shout out to you if you had GitLab. 21% on the day. Incredible numbers for them. United Health up on the day. Why? Because market's rotating a little bit more into value. Verizon, apparently they're down 3% today because they're in talks to buy a company. I'll get the name of the company in a sec. I believe it's Fiber something for a couple billion. And, you know, whenever you're doing an acquisition, the companies that's doing the acquisition stock tends to go down a little bit. So that's why they were down 3%, but it seems like that's going to be a productive acquisition. XLF financials were flat on the day. Bank of America down about 0.5%. Energy took a hit. Energy was below 70 today. WTI crude hit at $69.50 in the morning, which was just incredible. So regardless of if energy goes from 70 to 75 to 69 to 65 to even $80, we are going to see energy disinflation going into August CPI, definitely into September CPI, which is going to be really good because I think CPI is probably going to get closer to 2.5%, which is going to be important to see what happens. HPE has earnings. Okay, I did not know that. So let's make a little list right here. So we have today's 9-4, C3 AI, and I felt like HPE already had earnings today. Hewlett Packard, really? Does Hewlett Packard have earnings? I thought they had earnings. Okay, I guess they do. And then C3 AI. Hewlett Packard, I'm curious about, you know, if they say anything interesting around competing with Dell or some of the AI tailwinds or momentum they might be able to catch from everything going on, but we'll see what they have to say. Okay, C3 is up 5%. C3 AI is up 5% right now. So there are two HPs. Oh, yeah, you're right. There are two HPs. You're correct. Yep, you're right. HPQ and HPE are different. Yep, that's a very good point. Yep, they are different. That's fair. So the other one must have been the HPQ one that I was thinking about. Okay, so C3 AI, 2397. They're up 4%. Let's see if we can get some numbers from them. Numbers are not out yet. Hewlett Packard Enterprise not out yet, and then C3 AI not out yet, but we are seeing the stock react a little bit. Again, C3 AI, at this point, it's a $3 billion company. They used to be an energy company, used to be an IoT company. Now they're an AI company. Tom Siebel, I believe, is the guy who runs it. He's a legend in the SaaS space, but a lot of people don't have the best impression of him as well, given some of the controversies he's been stuck in. Particularly, I don't know if you guys saw the video I made back in 2022. It's a long time ago, but apparently they found out they hired or they licensed like 12,000 salespeople, but only 60 of them were actually selling C3 AI's product. And there was a class action lawsuit against them because it was like, what's going on? Oh, and now it's red. Now you're red by 8%. Now it's 9%. Holy crap. Now it's falling. So that lawsuit was not good for them a couple of years ago. And it made people think, hey, maybe we can't trust this guy. Now it's down 12%. What did they say? Holy guacamole. Look at this red candle, bro. It just hit 1970. Oh my God, bro. We're going to put Palantir here just as well. This is why I think Palantir is getting the premium, man. The reason Palantir is getting a premium is because these other companies just can't live up to the hype. Holy crap, dude. Down 11%. What did they say? UiPath is tomorrow? Yeah, Path is tomorrow. Path is not today. Path is tomorrow. Okay. What did they say? Let me see if I can get some of their numbers. It's recovering a little bit, but a recovery from 13% down to 10% is not the best. Okay, so here we go. They beat on EPS. They lost 5 cents a share. The market thought they would lose 13 cents a share, so they beat by 8 cents. Revenue, 87 million versus 86.94. So they beat by a couple 100,000 in revenue. It's a very slight beat on the top and the bottom, and I would imagine the reason they're getting hit right now is because of guidance. I would imagine that has to be the reason. C3 AI finally admitted they were a consulting firm. Oh my gosh, dude. Remember this stock, people forget, dude, this stock was at like $5. So it, what's that, 23? So it basically 4x'd in 2022, or sorry, early 2023. And it kept the valuation. Like it never left the valuation. The valuation sustained itself at this like 500% increase that it had. But granted, that's when it was trading under $1 billion. So you obviously had, a little bit more deeper undervaluation. Okay, while I'm working on C3, let's look at HPE. They just had earnings. Let me bring up those numbers right now. And then we'll get into C3 AI and see their numbers. And then we got a lot of macro stuff to discuss. We have a lot of new data on JOLTS. I want to talk about implications for that. So we'll talk about that after these earnings.
HP Enterprise driven by strong AI demand in the quarter. Start with that adjusted EPS number. This was 50 cents, a 3-cent beat. Their revenue of $7.71 billion. That was also stronger than expected, up about 10% from a year ago. Gross margins expanded in the quarter to 31.8%. That was slightly light. The street was looking for around 33%. Operating margins, though, in line at 10%. So an effect there of some of the cost controls going on. Guidance for Q4 is in line. And then server revenue, slight beat, while Intelligent Edge, rather was a slight miss. But AI was really a bright spot. HPE saw $1.3 billion in AI systems revenue. That was up 39% from last quarter. I did catch up with the CEO, Antonio Neri. He says that, quote, "We see acceleration in AI, which is driving revenue growth, and we grew profitability in all three businesses. Tells me that they have the right strategy going forward." Also says there are no signs, as he put it, of cannibalization. They are seeing growth in both AI compute as well as traditional server compute, and then said the server market is in recovery mode. Also says that $14 billion Juniper acquisition is expected to close in 2025. Says they've already gotten some key regulatory approvals. Guys, back to you.
All right, fantastic.
Okay, so HPE is flat. They are saying more AI demand, which is what we thought they would say, but the market really not caring too much after hours. C3 AI is down 14%. So this is the big mover right now. What could they have possibly said? The earnings were a slight beat on the top and bottom. It had to be something around guidance that got the street upset. Down 14% is a pretty dramatic decline. They're growing 20% year over year. They closed 71 agreements in Q1. That's the equivalent of like deals that Palantir closed, which is up 122% year over year, including 52 pilots. Wait, they closed 71 agreements, including 52 pilots? Okay, I wonder if those pilots are actually closed customers or are those like closed pilot deals. That's interesting. The company expanded its presence in state and local government and federal sectors. C3 generative AI saw strong demand, closing 17 pilots across various industries. So why does it say we have 52 pilots, but we closed 17? That's interesting. The company provided guidance for Q2 and full year 2024. I think that guidance, that's what I'm trying to get that number on. I would imagine that guidance is low, which is why the street is upset right now. Oh boy. Oh boy. Oh boy. Oh boy. This one's down. This one's down. For those asking why is Celsius down, dude, I don't know. All I know is I woke up this morning, it was at 37, then it was at 35, then it was at 32. I'll try to get a little bit of information on that, but I haven't actually figured out why Celsius has taken this big of a hit. Hold on, I just got some updates. All right, so we'll talk more about Celsius in a second, but it seems like the president was at a conference with Barclays and he said some stuff that was not good. Yep. Okay. I figured out what happened. So we'll talk C3, then we'll get through Celsius. Yeah. Some of these investor conferences, if you say the wrong thing, it can definitely hit the stock. Okay. HPE is now down 4%. C3 AI down 14%. Trying to find that final guidance number, and that'll give us a little bit more clarity on what's going on. All right. Here's the coverage. I got it. Let's pull this up. And then we'll talk into Celsius. Yeah, it has to do with Pepsi. We'll talk about that. Here we go.
Bottom line, an adjusted loss of 5 cents per share. That's better than the 13-cent per share loss that analysts had expected. Revenues of $87 million, right in line with expectations. Well, first quarter, and this is the quarter we're talking about here, fiscal first quarter subscription revenues were a miss, $73.5 million versus the $79.2 million analysts expected. Now, the company's fiscal second quarter revenue guidance is for a range of roughly $87 million to $94 million, pretty much in line with estimates, while the company is guiding to a fiscal second quarter adjusted operating loss that's a bit worse than anticipated. Its full year revenue estimates basically in line with what analysts are expecting, but that worse than expected outlook seems to be weighing on the stock, down 14+%. Back over to you.
All right, Julia, thank you. And coming up, CEO Tom Siebel is going to discuss those results with us before he dials in to the analyst call. And we're keeping Lori Phil with
Interesting. So they'll actually have Tom Siebel try to justify some of those numbers. Looks like they lowered guidance and they had a slight beat on the top and bottom, which was not enough for the street to get excited. The thing about AI, again, the reason Palantir is getting this premium is because they accelerated from 22% to 27%, and now hopefully in Q3 to 30%. C3 AI just said we're only going to do 20% revenue growth, apparently, if those numbers are correct, which means like you should be accelerating. You should not be deaccelerating, right? So they're staying stable at 20% or 20 to 23%, but they're not accelerating. And again, this is why it's so important for Palantir to beat that 27% number, which means they've got to do closer to $720 million versus the 701 they guided. Because if you deaccelerate, even for a quarter, that premium gets crushed. And we saw this basically happen with Celsius and their same store sales. So we obviously saw this with Snowflake as well. They went from like 35 to 27, now to 24. So still good growth. 24% is not bad growth. It's just not accelerating growth. And the market is about narratives. And when it comes to AI, we need to have a narrative. Wow. Is this real? NVIDIA says we have not been subpoenaed by the DOJ. Is that a real headline? NVIDIA flat right now after hours. NVIDIA did not receive a U.S. Justice Department subpoena. A spokesperson said in the statement on Wednesday, we have inquired with the U.S. Department of Justice and have not been subpoenaed. Okay, so that's different from after hours yesterday. What happened? Yesterday, you could say the entire reason the stock fell 10% in the morning was because they got subpoenaed. A subpoena is different from the DOJ having an inquiry into you. Like, there's a difference between meeting with some people from the DOJ and having a conversation versus a full-on subpoena where they're like, hey, we think you're doing some antitrust. We need to get into your monopolistic practices. That's a very interesting headline, dude. Bloomberg reported it yesterday. If Bloomberg got that wrong, that doesn't look good on Bloomberg. NVIDIA not really recovering from that after hours right now. I mean, maybe during the day it didn't fall that much worse because that DOJ stuff people figured out was fake. But if that was fake yesterday and that was the leak that people sold it on, you would imagine if that was the reason people sold C3 AI now down about 15%, it wouldn't be a reason to sell and people would come back and end up, getting back into their position. Even if that was true, though, I felt like such a weird reason to sell because I don't think anyone thinks we're going to break up NVIDIA. But that is interesting. That's actually very bullish for NVIDIA. Nancy called it off, dude. That's exactly what happened. Nancy called up whoever runs the DOJ. She called up Lena Khan at the FTC, and she's like, you know what? I've got a lot of fucking money riding on this. Can you guys just chill out? That's exactly what we did to the Bank of Japan when they raised rates. We were like, yo, chill out, guys. Relax. Okay, Celsius. Let's talk about Celsius. First of all, put in the chat if you own Celsius. Let me know who is bullish on Celsius. Do you own Celsius? Do you like this name? It's okay to be bag holding. I've bag held many stocks before. I will bag hold in the future. So it's part of life. It's part of the game. But at the end of the day, this is the reality you have to confront when a stock goes down to figure out why it went down. And then kind of come to the conclusion on, is the thesis broken or not? Okay, so at 12 p.m. today, Celsius CEO participated in a Barclays conference. Here's what he said. First of all, on Pepsi, he said, now through the first half of the year, we did see roughly over a 47 million decrease in orders associated with them optimizing their inventory levels as they're gaining more efficiencies with the relationship. We're improving supply chain timing. What we're seeing year to date, roughly 100 to 120 million of orders are being reduced from what they ordered last quarter. Oh, that's bad. That's not good. That's not good. So 120 million, I don't know if that's dollars of orders or literally 120 million packs of Celsius. I don't know exactly what he means there, but overall, it seems like a substantial decline in terms of what they ordered from Q2, which is bad. So we're still seeing these inventory levels being reduced. It has been increased in the third quarter. That's something we can't control. Okay. Chief of Staff said, and to be clear, when we look at Q3 of last year versus Q3 of this year, we're up 10% quarter to date, year over year. We're up almost a full share point. Sales are strong. And just to be precise, with the 100 to 120 million figure, we're seeing approximately 100 to 120 million less in orders to Pepsi in Q3 this year versus Q3 last year. So that's why it's really critical to understand that we recognize revenue when the product is delivered to Pepsi, because that's not correlated to what everyone is seeing in the Circana or Nielsen data. Wow. Okay. So they're addressing the Nielsen data. 3 weeks ago, Nielsen came out and said, hey, their same store sales are down 30% year over year. So Toby, the chief of staff, is like, actually, that's not as accurate because we only see that sale data when we recognize it, when Pepsi officially orders it. But the problem is they're saying Pepsi hasn't ordered about 100 to 120 million so far. C3 AI Now down 17%. That's a tough one. So it seems like that's what got the stock in a bad situation. Now, what he says, just to be clear, we're up 10% quarter to date year over year. I don't know if that growth is good enough for the street. Being up 10% quarter to date year over year, I'm not sure exactly how to interpret that, but that's not like big numbers if you're up 10%. If he means 10% compounded on last year, maybe it's bigger, but maybe that's also a reason the street's just not excited for some of the growth that they're seeing. Okay, last thing is impact on margins from Pepsi. We are going to see an impact in Q3, as I mentioned earlier, with Pepsi reducing their orders. That's going to impact the margins even greater than we anticipated. Yep, that'll do it. That will do it. That's going to hurt EPS and earnings per share. So those things that are going to impact the quarter, but overall, we have a competitive advantage. We see great opportunities for margin enhancement outside of the normal ordering process. CEOs on CNBC. Okay, so we'll analyze more of the Celsius news in a second after we watch this interview. But let's watch this, and then we'll break down some of that stuff on Celsius.
But expected. What's going on there?
It was a solid. Hi, John. It was a solid quarter. We beat revenue expectations, beat profitability expectations, beat cash flow expectations, cash flow positive for the second quarter, cash flow positive in Q4, cash flow positive in Q1. It was a solid quarter, and just across the board.
I get that. I tried to set that up as well, but there are these questions about expectations, and people expected something a bit different, particularly in the guide. So is it just a matter of people expecting what you're delivering that you feel is great and maybe a bit less than they had in mind? I mean, it sounds like the government part of the business in particular is performing quite well. You've got a solid cash reserve.
Okay, I think we have about roughly $750 million in the bank. Our subscription revenue was within the guidelines. We did not have a miss in subscription revenue. We were within the expectations there. I mean, it was a solid quarter. Markets move around a little bit from day to day, but I think across the board it was solid. State and local diversity is good. Federal government is good. Number of contract growth is great. The business that we're doing with the partner ecosystem, particularly Google Cloud, AWS, is huge. There's just nothing not to like about it.
So in light of that, Tom, what does that mean in terms of reacceleration of growth of revenue here and the traction for your AI offerings in the marketplace?
Great question, Morgan. I mean, our growth rate in the quarter, year-over-year growth rate was 21% year-over-year growth. I think that might be the 10th fastest growing company in the public software universe.
Okay, that stat is a bit exaggerated. Guys, this is a company doing 80 million a quarter, growing at 20%. That's just like Palantir gets 80 million off one deal. And I'm not just to compare them to Palantir, but if he says we're growing fast at 20% for a company doing 80 million a quarter, I mean, that's just like, that's not fast growth, especially not if you call yourself like the king of AI.
I believe our guidance, the consensus guidance that we have for growth this year is 23% top line growth. I think that is like the 7th to 10th fastest growing company in the software universe. In the public.
Okay, first of all, he needs to stop saying software universe. Second of all, 23%. Dude, Palantir got destroyed for putting up 23% growth. It's not until they finally got up to that 25, 27 that the market really rewarded them. So I don't think bragging about 23% is saying that you are accelerating growth.
Public software universe. So we have definitely our growth rate in the last 5 quarters has gone from 0% to 11% to 17% to 19% to 21%. This is a company that has, now that we're through our transition to the subscription-based pricing model, we have absolutely accelerating growth.
So what does that mean for profitability? I know you talked about cash flow positive, but when do we see some of those other profitability metrics begin to kick in then?
Great question. Well, we have a structurally profitable company. I mean, our gross margins are much, much greater than our cost of sales. Our revenue growth rates substantially exceed our expense growth rates. So profitability just comes with scale. I mean, this is a mathematical certainty that as we scale the business, it will cross into continually cash flow positive, and it's a mathematical certainty that if we continue to grow the business, non-GAAP profitability accrues.
So we've talked in the past about your new features that are kind of in the Gen AI universe and tuned specifically to the enterprise. What can you tell me about the specific use that, let's say, government customers might be getting out of that at this stage as these questions arise about ROI?
Generative AI is just huge, John, and the use cases that we're seeing are remarkable. I would say when we deal with public benefits programs like Medicare, Medicaid, Affordable Care Act, to be able to take this, the amount of information associated with these programs that are biblical in scale and use these to feed a learning model. This would be basically a small learning model or an enterprise learning model where you can ask any question about any program, Medicare, Medicaid, whatever it might be, in any one of 133 languages and get the right answer the first time. Generative AI is being used, in the Air Force for predictive maintenance applications. It's being used in the intelligence agencies. It's being used in the private sector for the most interesting and diverse applications they would never expect. For law firms, for writing their S1 and 10K filings. This generative AI area is unexpectedly diverse and unknowably large.
All right, Tom Siebel.
Okay. So nothing we thought 2 years ago about C3 AI has changed. I remember sitting in this exact seat in 2022, listening to an earnings call from C3 AI. That's when Palantir was at like $5 and C3 AI was at closer to 11 or $10. Palantir was at not $5. It was like $7 or $8 at the time. Palantir still had a higher valuation, but C3 AI was like their stock price was higher than Palantir. So everyone felt like, are they like the real AI guys? Their ticker symbol was AI. This was actually when it was going viral on Stock Twits. If you guys remember that saga, it went super viral over a course of about 3 weeks because the ticker symbol AI was there. This is when ChatGPT really started going mainstream. And this was either late 2022 or early 2023. And I think the analysis most of us in the Palantir community did at the time was that this just doesn't make any sense. And it's really not that comparable to Palantir. So now they are down 19%. Do they deserve a 19% drawdown? I don't really know. The guidance of 23% growth is just not exciting. It's very mediocre at best as a software company. I know he says it's the 7th best in the software universe, but compounding off of $80 million should not be that hard, especially if AI is accelerating. Again, I think the way to filter through all the BS when it comes to AI companies is, are they putting up the numbers? If they're not putting up the numbers, AI is not a tailwind. It's just that simple. OpenAI said, hey, we went from 100 million weekly actives to 200 million weekly actives in 12 months. They put up the numbers. You can argue valuation or not, 100 billion, 80 billion, whatever, but they're showing you that people are using ChatGPT. So from that perspective, I think it's really about numbers, and I don't think C3 AI, at least in this guidance, is putting up massive numbers. Someone shorted C3 Siddharth. He's up 500% on his puts. Congrats. That was not a bad trade. That was not too bad. Jamil77, thank you for becoming a channel member. Really, really appreciate it. Thank you for joining the channel and becoming a channel member. Okay, where's Palantir after this? Palantir's probably down a little bit because of this. Yeah, Palantir down about 0.5%. Residual AI companies taking a little bit of a hit as well. NVIDIA down about 0.12%. But overall, C3, they are down 17.95%. Okay, NVIDIA, going back to that Bloomberg news real quick. It seems like if you believe NVIDIA over Bloomberg, which I would imagine we should believe NVIDIA over Bloomberg, then NVIDIA has not been subpoenaed by the DOJ. This news came out at 3:58 p.m., or at least that's when I'm seeing this tweet right here. NVIDIA has not been subpoenaed by the DOJ. That is what caused the majority, in my opinion, the sell-off yesterday. Apparently, the DOJ just wanted to ask them some questions, but it was not a formal subpoena, which is very different. And if Bloomberg reported that inaccurately, then that's not a good look. That's not a good look on Bloomberg. So I'm curious if NVIDIA rebounds from that. I would imagine they do, unless that sell-off was more algorithmic and technical. But if it was based on the DOJ, then hopefully there is more momentum coming on from this new news addressing what happened with the subpoena. Okay, going back to Celsius real quick, and then we got a lot of macro stuff to discuss. So we were talking about Celsius. It seems like there's a couple things going on. Number one, their margins are getting hit badly, and the margins are getting hit because of the Pepsi deal. Which is contributing to a lack of growth. Number two, it seems like because Pepsi is ordering $100 to $120 million less of orders, that is going to affect their Q3 revenues and definitely their full year guidance. And they're already seeing a $47 million decrease in orders associated with optimizing the inventory levels with Pepsi. So that's not good. And then they're trying to cover up this Nielsen data leak that came out about a month ago that Celsius sales are down year over year in terms of same store sales, which is the most important metric for retailers or for distributors. But that is not what the street cares about. So margins getting compressed, Pepsi's ordering less, and not really that much clarity on the Nielsen data around same-store sales, which is likely why the stock is taking a hit. Celsius now, after hours, it's up a little bit. It's down 11% on the day. Yeah, look, I mean, I got to go deeper into the valuation, man. I don't really understand the valuation that much. I know, so their market cap's $7.5 billion. Monster is at $47 billion. There was a moment in February where Celsius was $99 and their market cap was 66% of Monster's market cap. And it doesn't take a genius to know that Monster is way bigger of an energy drink brand than Celsius. Celsius is growing, but Monster is like the king. Monster and Red Bull pretty much are on the throne here. So that itself kind of felt like it started to get overvalued, but you're not buying it at 99. If you're buying it right now, you're buying it at 32. So theoretically, the valuation should become much more attractive, even if the growth is slowing down a little bit. I would have to dive deeper and see if there's anything exciting here, if there's an opportunity. The problem is I don't like that it's down that much either. You know, there's something around internally that investors are thinking of that is an issue with Celsius. And maybe it is this Pepsi deal. Maybe it is margins. But when a stock falls like this, unless there's like something that is much more inconsequential to the stock falling, it's not usually the best dip. But maybe the margins are inconsequential. Maybe it's just a 1 quarter thing, and maybe it'll rebound over the next couple quarters, and that's where it becomes an attractive dip. But Celsius right here down 11.6%. We'll do some more DD on that and see if there's anything attractive there. I would imagine if you're selling puts on it, the premiums are good. But again, the downside to selling puts is that if the stock falls, you get assigned on those puts. And so if you get assigned on those puts, you have to be willing to own those shares. Palantir right here down about 0.49%. C3 AI still down 18.6% on the day, which is pretty bad. Pepsi might buy Celsius. Maybe that's another reason people are selling it off a little bit. They kind of think, their organic growth is done. They're not going to become a Monster or Red Bull. They're just going to get swallowed up. I don't think, from the little I've heard of the Celsius CEO, he seems more ambitious than wanting to get acquired, especially given how they're taking the brand in a new direction. So I think they want to go all the way, but that might end up being a rumor that starts proliferating around Celsius. AMD, let's take a look at the semis, and then we'll talk more about macro. So first, the Mag 7. Mag 7 on the day, Apple was down about 1%, Microsoft down a little bit. Meta was green on the day. Wow. Google ended slightly red, 0.5%. Amazon was down 2%, 1.6%. There's actually some controversy with Amazon. I'll show you guys in a second that controversy. It has to do with Alexa. I'll show you guys the video in a bit, but Amazon's down about 1.6%. Nvidia right here down about 1.6%, and then Tesla ended on the day up 4%. So Tesla was the greenest of the green out of the Mag 7. If we go to the semis, all of them were down on the day. Broadcom was up a little bit. Qualcomm was up a little bit. TSM ended up about 0.5% or 1/4%. Marvell was up 1%. The rest, ARM, Dell, Intel, SMCI, AMD, and Nvidia, they all took a little bit of a hit. AMD actually ended up 2.8%. So AMD was a little green. So mainly Nvidia and Intel were the ones that took a deeper hit today, along with ARM and Dell, down about 2%. The rest of them had a slight rebound, if you want to call 1 or 2% a rebound after falling 8% yesterday. So semis were not in a horrible situation today as well. Zach Coles, thank you for becoming a channel member. Really appreciate it. Again, thank you, Zach Coles, and thank you for Jamil77 for becoming a channel member. Really appreciate it. Thank you for joining the channel. Okay, so let's talk about macro. First of all, speaking of macro, the jobs report is not tomorrow. It is on Friday, and that's what I want to discuss right now. Tomorrow, I think we get jobless claims, if that's what you're talking about. So I think those will be fine. That's not that big of a deal. But the jobs report on Friday is what we really need to care about. All right, so we had a couple things happen today. After the JOLTS report. So what is JOLTS? JOLTS are job openings in the United States of America. We are at, and I didn't say this in the morning because I didn't get to see the stat, but I found out after the market opened. We are at the lowest level of job openings in the United States of America at 7.9 million since January of 2021. So this is likely why Fed futures by about 12 p.m. started pricing in not 25 bips, not 25, 50 for September. They were not pricing in 50 for the better part of the past 3 weeks, even after the dovish Jackson hole that we got. The reason now it's 50 is because that JOLTS report came out to be pretty aggressive to the downside. You only have 7.9 million jobs open in America. That's still a ton of jobs, but it's the lowest level in comparison by 2021 standards, which is, necessarily not the best thing if you're talking about the labor market not being as weak as people thought it would be. Now, here's a couple stats in the context of this. So first of all, part of the reason we have so little jobs or part of the reason why we're getting a less labor force participation is because people are quitting. So United States jobs quits are now hitting some of the highest levels that they've hit in the past 7 months. One of the arguments you could make for why people are quitting their jobs, which is actually a bull argument for GDP, is that, okay, if people are quitting their jobs, they're starting their own businesses. The problem is starting your own business is really, really difficult. And if you're not successful in that business, you're not going to contribute that much to employment, to new products and services, to GDP growth, to tax revenue, etc. So you might have some people that are quitting their jobs. Maybe some people are going on gap years. Maybe they're going on vacations. You've got this whole kind of new momentum around Gen Z. They work in corporate for a couple of years, then they take their savings and they go travel the world. Like maybe some of that stuff is happening, but JOLTS quits ticking up in July kind of showcase that there is a reason people are quitting. We don't exactly know what the reason is. Maybe it's bullish because they're starting their own businesses. Maybe a bunch of AI entrepreneurs are starting companies, or maybe people just don't want to work in corporate America anymore, work at their regular jobs, and they're using their savings to live off for a while. That part is a little bit more bearish because then, it's bullish because I guess they're consuming more because they have to spend their money to survive, but they're not necessarily bringing in more income, which is not the best for broader GDP growth. So that's one stat to pay attention to in the context of the jobs number. And then here's the next thing that came out at 12 p.m. after we got this JOLTS number. Bank of America says we're going to get 200,000 jobs. Non-farm payrolls, Bank of America says we're going to get 200,000 jobs. My bull case was 125. And then I think, okay, we're going to get the rate cut. The market's not going to freak out. We're good to go. If we get 100 or below, I think we're tanking like 3% on Friday. I think it's going to be ugly. Bank of America says we're getting 200,000. As you can see, the reason we tanked in August, by the way, is because July we had 114. This was severely low against the estimates. And that's why you saw the August 2nd collapse. And then after the August 2nd collapse, you saw the yen carry trade, and then the whole market fell 10%. So, if we get 200, I'm going to be very, very excited. I'm going to be very, very happy. I don't think we're getting 200. You could argue maybe somehow magically we're going to get 200 based on how the numbers pop up. I don't know. Maybe we'll see what happens. I think it's more likely to be 125 to 150. And if we get to 125 and 150, that's hopefully going to be enough for the market to not care too much. But those are two things around JOLTS data. We're getting a lot more people quitting, and Bank of America thinks we're going to get 50,000 jobs. Now, as soon as the JOLTS data came out, Citibank at about 11:30, they put out a note to their clients, and they said, you know what, guys? Based on this new jobs report, or based on this new JOLTS data, we expect the Fed to cut by 50. And I think this is also what allowed the Fed futures to start pricing in that 50 basis point cut. Now, why does this matter? So this is Citibank. Citibank is one of the, the bigger firms on Wall Street. When they come out and they say, hey, we think we should cut by 50 right after the JOLTS data, it's because they're basically saying the JOLTS data is so bad, aka so weak, that if the Fed even cut by 25, that's not going to be enough to get the job, to get the ball moving. Now, you may say, oh, well, Citibank, Goldman Sachs, JP Morgan, who cares, right? They're just Wall Street firms. They can say whatever they want. Sure, that's fine. That argument is okay. But at the end of the day, Citi is the one that's advising all their clients. And if they're expecting 50, or if JP Morgan, Goldman Sachs is expecting 50 and they don't get 50, they're going to tell their clients on Friday, sell. Or at least they're going to tell their clients, don't buy, because you're going to get a better opportunity once we get more rate cuts. So I think the perception from the banks, Citi, JP Morgan, Goldman Sachs, et cetera, is important for the broader equity markets, because ultimately, if they think JOLTS was bad enough to the point where the labor market is cooling to such a degree that the Fed needs to cut by 50, then if the Fed doesn't cut by 50, which I don't think they're going to cut by 50, I think there's a chance, but I don't think it's going to happen, that might be interpreted in a negative way. So here's the question, and I'll do a poll on this one. Here's the question. We're doing polls a lot more. I like this. I like that we're incorporating polls because outside of my night job dancing on polls, we should probably use polls in the stream a lot more. So here's the question. Here's the poll that I'm going to do. Here's the poll. Is 50 bips bullish or bearish? Bullish or bearish? That's my question. I have a couple perspectives on this, a little bit of nuance here, but bullish or bearish if we get the cut? Bullish or bearish? Let's see what you guys have to say. Let's see what you guys have to say here. Because I think it's one or the other. I think it's nuanced based on the jobs report, but I'm curious what people have to say before I give my thoughts and see if it's bullish or bearish. June says that was a good one, Mitt. Thank you, June. This is like that. You know what? I got to play this video real quick because June, your comment right here is exactly how I feel right now, given you're the only one that acknowledged my joke. I have to play this right now, June. I have to do it. You have inspired me to do it. This is exactly how I feel when only one person acknowledges my joke. Here we go. You guys ready?
Bush
had an even worse one.
He's having a clap in the business of creating a more peaceful world. Please clap.
Dude, that was pretty crazy. In 2016, when he had to ask the audience to clap, it's like, all right, this guy has no charisma. This guy has just no charisma at all when he was running for president. All right, so 50 bips, bullish or bearish? Most of you say bearish. So here's my perspective on this. There's 3 different scenarios in terms of how this plays out, all right? On the jobs report, if we get a good jobs report, I'm not going to give numbers, but just like good or bad. If we get a good jobs report and we get 50 bips, I think that's bullish. Why? Because 50 bips it seems like in its emergency cut, but honestly, it's just the Fed saying, hey, like we were too slow. That's it. The Fed is finally acknowledging we were too slow. We're coming back. And the market might be thinking, okay, the Fed is not absolutely full of shit. They're actually going to cut because they realize the labor market is at the lowest level since January of 2021. Some metrics are showing it pre-pandemic in terms of ISM manufacturing data, et cetera. So maybe the Fed is getting their shit together. They're going to cut rates by 50 bips, even if we get a good jobs report. That's the ultra bullish scenario. The bearish scenario is we get a horrible jobs report, meaning we add less than 100,000 jobs or 110,000 jobs, and we get 50 bips, then we're in a recession. Why? Because if we get a bad jobs report, it doesn't matter if you do 50 bips, 100 bips, 150 bips, 200 bips. Like, it really doesn't matter. The effects of a rate cut takes about 18 months to be seen in the economy. That is empirical, and no one can argue with that. So we're not going to see the effects really until 2026 of the rate cut. This is all about pricing it in from a stock market perspective because we own stocks. So we want those stocks to be priced for the rate cutting cycle. So these prices that we're getting in the stock market is contingent on a rate cutting cycle that is being priced in, not because, oh, the Fed cuts rates on September 18th and by October 18th, there's all this demand that pops out of nowhere because now companies can start borrowing capital because the cost of capital becomes lower. It takes a while for that stuff to happen. If we get a bad jobs report and we get 50 bips, it means the Fed is being reactionary. And if the Fed is being reactionary, then I think we're screwed. And I think we would have to seriously evaluate if we should still be bullish. And that's me being as objective as possible, right? We're not going to be bullish to be delusionally bullish. If we get a bad jobs report and we see more consumer struggling, more like pain in the consumer based on all these different earnings reports about certain companies having a problem with consumer spend, then yeah, the 50 bips is not going to save us. You know, maybe there's an odd scenario where somehow 50 bips ends up working, even if we have a bad jobs report. But I think if unemployment ticks up from 4.3 to 4.5, things go bad. So that's the bullish scenario. That's the bearish scenario. Now, here are some nuances to that. S&P 500 right here at 550.95. Where's NVIDIA after hours? NVIDIA up just a little bit at 106.23. What if the jobs report is good, not great, but we get 25 bips? I think that's bullish because that means the Fed's not moving to the point where they're showing an emergency cut, but jobs aren't horrendous, which means you don't need to cut that much theoretically. You know, one could argue inflation could reaccelerate. I'm not really in that camp, but one could also say, hey, the Fed doesn't literally need to go balls to the wall. They can take their time. And we have decent jobs. Now, if you get really decent jobs and the Fed chooses not to cut at all, that can also be very bearish. Based on what Bostic said this morning, I don't think there's any chance the Fed doesn't cut. But the other scenario is that, hey, we get a good jobs report, we get 25, that's good. The other argument that's bearish is we get a good jobs report, but the Fed still cuts by 50, but the jobs report is not as good. Meaning, let's say instead of 200,000 jobs, sorry, it's the inverse of the explanation. Let's say we get, 250, 300,000 jobs, crazy good job growth, but the Fed still cuts by 50. That's where I think that could be bearish. And the reason that could be bearish is because now the Fed is not even acknowledging that we added so many jobs, or they don't believe that we added so many jobs, which they said last week they didn't believe in the BLS revision. And so that they kind of expected the BLS to revise. Why are you cutting by 50 bips? Why do you need to cut by 50 bips? Like, there's no reason to cut by that aggressive of an amount if we have such great job growth, because then the question really starts forming like, hey, because the Fed knows something that we don't know. So I think if we get a decent number of jobs and 50 bips, that's not horrible. A decent number of jobs and 25 bips, that's not horrible. A bad number of jobs and 50 bips, that's really bad because the Fed's acknowledging they lost. And then if we get a really great number, like imagine we had like 500,000 jobs. That's not going to happen, but imagine that does happen, like a sort of resemblance of that number, and we still cut by 50 bips. That can definitely be interpreted as bearish because the market's going to be wondering, why is the Fed moving so quick after not moving quick for 18 months of keeping the Fed fund rate at where it's at right now. And so literally on Friday morning at 8:30, all these different scenarios are going to be playing out in real time. We're going to see how the markets choose to reconcile with all these different scenarios. Either the market's going to agree or disagree with how it plays out. But at 8:30, we will get numbers, and those numbers will then determine, is 50 bullish or bearish? It looks like the Fed futures are putting in 50. It looks like Citibank says 50. I wouldn't be surprised if JP Morgan, Goldman Sachs comes out tomorrow. They say, hey, we want 50 as well. They've been saying 25 for 2 weeks. If they start saying 50, maybe they manifest 50. And then the question is, does the market like that or hate that? We have a 50-50 on the poll right now. 52% say bearish, 48% say bullish. So kind of 50-50 on 300 votes of what you guys think on if 50 bips will be good or not. Jobs report is always a lie. Look, I agree. The more I study the jobs report, the more I'm realizing these numbers are not necessarily the most accurate. But at the end of the day, if these are the numbers we have to go off of, then we have to make decisions based on these numbers. So we'll see. We'll see what they end up putting up in terms of these numbers. And then if they get revised in the next couple months, it's going to be this is why I'm still not buying the dip. Some people were asking me today, hey, are you buying the dip? No, not buying the dip yet. I think we still have a lot of volatility left in September, October. We have the election to go through. We have some new updates on Kamala Harris. We'll talk about that in a second. Until we get through that, unless prices just get stupid, not really engaging in buying the dip yet. All right, here's Ryan Detrick. Let's get his thoughts. He has a lot of data when he backs up his analysis from historical perspectives on what he thinks around this bull market. Let's listen to him, and then we'll get deeper into some of the new stuff that Kamala put out today.
Group Chief Market Strategist Ryan Detrick. Welcome back. It's good to see you.
Thank you for having me back, Scott. Appreciate it.
You've been pretty bullish, if I recall. Are you still, or are you wavering because of the market, the price action in this market?
No, yeah, we've definitely been bullish. Still remain there, similar to probably every guest you've had on for the past day and a half. Yes, the calendar is a potential worry. The first rate cuts coming, the election. We all know those things. I'll just say this. Yesterday was the third 2% down day of the year. Obviously, it wasn't very fun for the S&P 500, most stocks in general. But Scott, look at it. The U.S. dollar was barely higher, okay? If you look at like what happened the last 2 days with high-yield corporate bonds, they're actually higher than they were on Friday. What in the world does that mean? That's like, this isn't a major risk-off scenario, but some more volatility, it does make sense in September, we think. And October, to be honest. October of an election year is usually pretty rough. We wouldn't be surprised at all if we had, 5 to 7% pullback. Makes a lot of sense.
Well, let's just get to the heart of the matter. Can the market go up if NVIDIA goes down?
Yeah, we think it can. I mean, it's proven that. I mean, it did last week. I know that's just one small example. We're more neutral technology in general. And again, you see what's happening. I love Chris's conversation. We're a little different than what Chris thinks. We do think this broadening out is real. You look at various advanced decline lines hitting new highs. You've got small caps and mid caps. No, small caps are kind of a dirty word a lot of times, but mid caps quietly are doing really well. That's our biggest overweight. So we think, the market can hang in there just fine if NVIDIA has trouble. If tech in general falls apart, sure, that might put a little damper on things, but overall there's still some positives out there. Just one final comment, on Friday, all-time highs for industrials and for financials. That's not what you tend to see if an economy is truly about to fall off a ledge here.
No, but I mean,
by the way, that also means we get more rotation, which is important. So if NVIDIA could chill out for a couple months, but the rest of the market rotates, NVIDIA's already up 150% year to date. That's not the worst thing in the world.
There are legitimate questions about the durability of the economy, the labor market, and thus the broadening trade for good reason.
No, you're absolutely right. I mean, look at today's data. I'm going to talk about the jolts. There's some concerns there. You look, hiring's up 5%, but hey, layoffs up, over double digits. I mean, so there are some cracks that are out there. And again, that's why we've been in the camp. The Fed probably should have cut last time. No, they did not. But, we think we know the cuts are coming. But we think this is, again, more of a mid-cycle slowdown, not the beginning of a recession. I looked when the Dow hits a new high, go back to 1900. 6 months later, you're in a recession, less than 10% of the time. It's not very likely. The people need to remember this. The best leading indicator we have is the stock market on the economy. So the economy might slow down, but with stocks doing what they're doing, it's just hard for us to see a recession the next 6 months or so.
What if the Fed's already too late?
Yeah, well, honest to goodness, they probably are. I mean, you look at the inflation data. I've come on, with you guys for a while saying the inflation is last year's problem. But again, the Fed's voice goes a long way, and that's that big debate you talk about all day. Is it 25 basis points? Is it 50 basis points? I think if it's 50, it's kind of the Fed saying, well, we were behind the curve. Market might not like that. I think ideally a 25 basis point cut with clear, lingo that there are more cuts coming. Again, as every time we see data like today's data. I mean, the jobs data, the employment labor backdrop continues to weaken. So more cuts need to come.
But I mean, if the Fed is already too late, and you admit that they may be, these cyclical areas of the market are the ones that would likely get hit first, right? I mean, if you go right back to the playbook, if I'm worried, well, I'll just play some offense and some defense into mega caps. Why take the risk elsewhere?
Well, no, you made some good points there. Again, I'm kind of an old school message of the markets person. I mean, we are seeing the leadership. So clearly the message market's not worried yet. But I will say this. We've got advisors in 42 states, and we manage a lot of money at the Carson Group, and we actually added some low volatility ETFs in a period of high volatility. You want to have low volatility. That's the way you combat that. And what's interesting about these low volatility, yes, there's consumer staples in there and utilities, but it's actually a decent amount when you peel back the onion, so they say, of financials and industrials in there. So that's one way that we've been very bullish for a while, added some low volatility. If we get, again, a little standard volatility scare ahead of the election, we should be okay. But honestly, Scott, we still think financials, industrials are the groups you want to be in the next 6 to 12 months, as this economy is simply having a slowdown, not entering recession, probably accelerate later this year.
Either of those are going to be famous last words. This economy is having a slowdown, but not a recession. Or those words are going to make his clients a lot of money. It's really going to be one or the other, dude. We're getting to the point where either, hey, it's a slowdown, it's not a recession, is like, it's the last thing you say before you get into a recession, or it's exactly the type of soft landing attitude that you need to see. One thing I will say, I was on Instagram earlier today after the market opened, just like looking at a couple things. I was actually, you could call it doing due diligence on the consumer. And remember I told you guys yesterday, if you do #Target and you guys kind of see people, that the fact that they're spending, dude, I cannot tell you the amount of videos, and I know this is anecdotal and this probably can't be the best evidentiary source, but look it for yourself on Instagram, TikTok, YouTube, #Target haul, #fall candles. There's so many people spending so much money. Just like spend like you don't need fall candles. You don't need to smell pumpkin in your house. It is a luxury in the first world to walk around your house and smelling pumpkins. Like, you don't need to do that. But people are doing that, and they're paying $20 for these candles. Like, it's just, I feel like if this was such a horrible, cataclysmic, disgusting recession where everyone's penny pinching, where you're afraid to literally think, hey, can I afford this piece of coffee? Or, hey, can I afford this $20 candle? You wouldn't see that type of content. You just wouldn't see people talking that much about how they're buying or selling stuff. And so I don't know, dude. I mean, again, that's not the best source of evidence, but look for yourself. Just look at the thousands of videos that not all of them are influencers. There are people that have like 100 followers. It's not people that have like, 5 million followers that are getting paid by Target. These are regular people that are living paycheck to paycheck that want to have their house smelling like pumpkins because it's September, October, which I get. I have no problem with that. The problem is that's disposable income that is being spent on a candle, which is contributing to Target's earnings, which is good for GDP, right? So it's just a question of like, do you feel things are getting that bad to the point where that consumer spending is going to go away? And maybe it's going to go away eventually. But as of now, it's not, at least from what I'm seeing, not going away in that bad of a situation. And again, when you look at Walmart and Target and Costco earnings, Dick's Sporting Good earnings today, I know I'm being a little anecdotal here, but when you look at the actual numbers from the big guys, they're also showing that the spend is not necessarily going down as aggressively either. Okay, 2 more headlines. First, Robinhood. We talked about the Palantir 2x leverage ETF. For those that missed that news, we will have a new 2x leverage ETF on Palantir pretty soon. I think launching this week. So that will be coming out. I think it's ticker symbol PTIR. And we'll see how that one ends up performing. I'm curious to see how much assets under management that one ends up getting. Could that get to $1 billion in the next couple of months? Like that would be kind of crazy because that would be like NVIDIA level growth in terms of AUM. Probably wouldn't happen unless Palantir goes up like 30%. Then you'll get people interested. But if not, we'll see. Here's one on Robinhood. So today, Robinhood rolled out stock lending in the UK, which is really interesting. The UK doesn't have a lot of features, as Crossroads says right here. They only have buying and selling. They don't have options. They don't have ISAs. They don't have a lot of different features that people in the UK care about. Already, people in the UK aren't as vesting as much from what people in the UK have told me, that it's kind of like taboo to invest your money. It's not as big of a trend as it is in the United States. Robinhood did make $34 million net on security lending last quarter in revenue. So I don't think this revenue is going to be super substantial for Robinhood, but it does show that they're expanding to the UK. They're continuing to bring new features to the UK, like they said they were going to do. A lot of people have been asking for tax lots. That's probably going to come out later this year. Vlad did say a couple of months ago that it would be rolling out towards the end of this year. And it's good. Ultimately, it's good because you want to see more features coming out into the UK and for people that own Robinhood as well. Sanjay says trading 2112 or trading 212 is better than Hood. I would agree with you. From people that I heard in the UK, they agree that Robinhood is not comparable to trading 212. By the way, why is it called trading 212? That's such a interesting name. Like it's not the easiest name to say, but yeah, from what I've heard, people like trading 212 way better than Robinhood, which is fair. It has more features. And so as bullish as I am on Robinhood, they're not really succeeding aggressively in the UK. I don't think they need to right now. I think if they just focus on the US markets and kind of continue to penetrate, they're going to be all right. But the UK is on their ambitions. Hopefully Canada, Singapore, et cetera, is also on the ambitions for the long term. And it looks like they're rolling out new features into the United Kingdom as well. So that's what you got in the context of the UK. Trading 212 already has lending. Yeah, I would imagine they're way ahead of Robinhood, but Robinhood's, they're going to have to do something unique to differentiate in the UK because so far I haven't really seen anything that's interesting. They're going to have to do something. I don't know what it's going to be. Maybe they give you 2% on your money or something. Now there's no payment for order flow in Robinhood. So that's another thing. They have to figure out how to get people to subscribe to Gold, but they really haven't turned on marketing. I think when they turn on marketing as well, that'll be bullish for them. But so far the UK has not been that big of a thing. You guys are talking about, Amit, would you ever get waxed? I told you guys, I asked my mom when I was in 3rd grade, because my arms were as hairy as they are right now. And I said, hey mom, should I shave my arms? And she looked me dead in the face and called me a little bitch, called me a pussy. And from then I've never felt self-conscious about any of the hair that I have on my body. So yeah, I'm not going to be waxing my hair. I went through that phase in 3rd grade. Didn't happen. And we moved on from there. It kind of went back against my mom because then I grew out my beard because I was so comfortable with my hair. And for 5 years, she was like, hey, you look like a terrorist. And I was like, well, I'm going to keep my hair. And then finally I decided to shave off my beard. But that's what my experience was in regards to keeping or not keeping hair on my body. All right. So Kamala Harris, this is our last big story for the day. Kamala Harris, we've been talking about unrealized capital gains for a long time. It seems like a long time for basically the past month when they proposed this. Well, when did I tweet this? August 19th. So call it 3 weeks when she proposed this capital tax stuff. So today, Harris advisors out of the Wall Street Journal are telling her to walk back from the unrealized capital gains tax proposal. And apparently Harris is deeply considering it. It looks like the Harris admin realized, or at least Harris advisors realized, that the majority of people are not a fan of this policy. And so she hasn't officially walked back the proposal, but the team, the Wall Street Journal reported, is seriously considering it. Again, the debate is in 6 days with Trump. And instead, maybe this is why this news leaked yesterday, they want to give a $50,000 deduction for people that are starting a new small business, up from $5,000, which is a $45,000 increase, which is pretty aggressive. That definitely would be beneficial for people starting small businesses. And they want to target 25 new small businesses in the United States. If you didn't know, 66% of businesses, 2/3 of businesses in the United States are small businesses. They're not the Amazons and Googles of the world. They're your local mom and pop pizza shop, grocery store, convenience store, etc. So the majority of businesses are small in America. They're the backbone of America. And Harris wants to give people a $50,000 deduction to start that business and potentially not tax them as aggressively as she was thinking about before. What's interesting about this is that the public perception has been hit in a pretty bad way. So from what I was seeing on Twitter and what people are thinking about it, they're like, hey, we're happy that she's taking back this proposal. NVIDIA up a little bit right now in the after hours, but this basically told us how aggressive and progressive Kamala Harris is going to be if she ends up getting a lot of power. And I think we're seeing it right now in the Trump polls. Trump is up. Nate Silver said he's up 58 to 47. If you believe Nate Silver, that's an 11% increase in terms of his potential chances of winning. Again, Nate, you may say he's not the best source. He's not always right, but there are some parts that he got right in 2016. Other polls are showing Kamala's ahead. So, really, these polls, you never fully know what the right data is. But if she thinks and her team thinks that Trump's getting a lead because he's framing her as a communist, which, let's be clear, I don't think Kamala Harris is a communist. I think some of these policies are kind of ridiculous, but just from a business perspective, if that framing of her as a communist is bad, then that's ultimately going to be, one of the arguments for why the American public might end up not voting for her. That might be one of the arguments for why people vote for Trump, is just like they can't stand NVIDIA actually going up a little bit right now in the after hours. That might be one of the reasons they can't stand some of the pain that she might inflict on them in terms of the economic policies that she's doing. So I was really flabbergasted when I saw this, because this was Biden's proposal that Kamala backed for the past 4 years. This is the full year 2025 budget proposal. She was a fan of the wealth tax, the capital gains tax, unrealized, all this stuff. And today she finally comes out and says, well, not officially, but the rumors are that she's going to go away from the C3 AI, still down 17% on the day. And so, you got to ask yourself that question. If it's that unpopular, we saw Ro Khanna, who's a Kamala Harris supporter. The problem is he's in Silicon Valley, and he knows that, hey, all these tech founders are not going to start businesses if we tax the crap out of them, especially their unrealized gains, which most of them have a lot of unrealized gains. That would end up being bad for the broader economy. That would end up being bad for Silicon Valley, for technology, for innovation. So it seems like Kamala Harris is taking that more seriously and taking away some of those proposals. I'm going to be curious to see if any of those proposals actually still make it into the final budget that she puts out. 87 million and $3 billion market cap. C3 AI is trash. Yeah, I'm not gonna lie, dude. I'm seeing some people just tweet right now about C3 AI at 87 million. The comments under my Twitter post are saying you should be growing 100%. I agree, dude. At 87 million, you should be growing at least 30%, if not 50% at a bare minimum. Growing at 23% means that there's no accelerating revenue. Also, they're talking about their government business. Palantir is the one that's winning a lot of these prime contracts from the DoD. There was some news by Arnie actually on Palantir. Let me pull that up real quick as well. Apparently, the Maven contract for Palantir is going really well, and it looks like they're going to re-up on that contract. But you should be winning very, very big deals. You should not be growing at 20%. One thing that's really important, Palantir won a $480 million deal with Maven. C3 AI just did $87 million of revenue. That means C3 AI's TTM revenue is less for on an annual basis than Palantir's one contract. That right there, I think, should highlight the difference between what's kind of happening here. So on the Wall Street Journal, Project Maven has grown into one of the military's hottest tools for intelligence and targeting, with it plans to expand its user base by 10-fold. Maven's laudable flexibility in letting users build custom code or even their own AI models, aka KLMs, has begun to strain his agency's resources, or as he puts it, success begets challenges. Maven was a $455-year contract, $480 million 5-year contract. I could imagine this thing gets re-upped to another $500 million over the next 4 or 5 years, simply because they're getting so many use cases from it. They're seeing so much advantage from it. 31% of the $480 million was guaranteed in the first year, so about $153 million. It seems like the Army is getting, and the military is getting, a ton of benefits from Project Maven right now. So again, at the end of the day, for C3 AI, it just seems like there's not a big government moat. There is not a big commercial moat in terms of revenue. And Palantir is probably the clear winner. For Celsius, it seems like you got to be confident that their growth is going to stack up and margins are not going to get as compressed as they were from the Pepsi deal, which might take some time for that to happen. And then the S&P 500 here basically flat on the day. So the big headlines really were Celsius with this 11% drawdown, Palantir with that new 2x ETF, and then you've got NVIDIA that was here down about 1.66% on the day. Again, NVIDIA had a pretty reasonable day. If they're not getting subpoenaed by the DOJ, and that's accurate, which if NVIDIA says that's the case, I'm going to believe Jensen over Bloomberg. then maybe tomorrow you get the buyers that come back in that sold it because of that DOJ stuff. Because again, if NVIDIA was going to drop 15%, it should have happened on earnings. Nothing happened between now and earnings for them to drop 15%. You would imagine it's a little bit more of a sell the news type of event. And if the news was fake, then maybe that's not a reason to sell the news. So that's what we got in the context of NVIDIA. Do you guys want to watch Noto on CNBC? I have that clip if you guys want to watch it. I know some people watched it on the Market Open today, but I thought it was really good. I thought he crushed a lot of the questions. I thought those questions were very strong, and it seems like he's pretty confident going into Q3. And if he continues to retain this confidence and we get rate cuts, he did say he really wants to see 25 to 50 bips, more emphasis on 50 bips, then we should be getting higher guidance by SoFi. Does Celsius make a mayo flavored drink? You know, if they did, they probably deserve to be down another 40%. But no, to my understanding, they don't. They don't do that. Okay, so that's what we got. That's what we got there. Okay? So we'll play a little bit of we'll play the 3-minute version of Noto instead of the 7-minute version. So we'll play the smaller version just for the people that didn't get a chance to listen to him. But this is what he said today. And then we'll listen to Dan Niles. You know, Dan Niles is making some very interesting arguments around their AI names that we should be paying more attention to along with the broader macro. So here's Noto. Then we'll listen to Niles and then we'll be done for today.
The biggest players in the fintech space, SoFi CEO Anthony Noto. Welcome back, Anthony. It's good to have you. What are you seeing on the delinquency front?
Well, Sarah, thank you for having me, and I appreciate coming on there. In terms of consumer activity more broadly, and then I'll talk specifically about the credit card business, consumer activity and sentiment is trending okay. And I think as long as the Federal Reserve cuts rates 25 to 50 basis points, that trend will continue. A couple of data points.
Notice he said okay, not good. Basically, he's saying, hey, if the Fed doesn't cut, it's going to get really bad. But right now, it's like manageable.
That we're seeing that should be instructive for the audience is what's going on with the SoFi member. Again, a SoFi member is a higher income member, higher credit, but it is indicative of some part of the market. We're seeing debit spend continue to be very strong. It was strong in Q2 and continues to be strong in Q3. But importantly, that debit spend is not coming at the expense of deposit growth, which also remains strong. The second data point I would share with you is in our invest business. We saw about 50% growth in net flows in Q2 in our assets in our invest business, with a lot of interest in alternative assets, which we launched at the beginning of the year, but diversified investments like ETFs and robo. And we're seeing strong net flow growth again in Q3 as well. And then on credit cards, to your specific question, our portfolio is quite small. It's growing nicely. We are seeing improving entry rates into delinquency. We cited in Q2 that we saw a 20% improvement in entry rates into delinquency compared to 2023. And we're seeing continued credit performance trends in line with expectations in Q3 in credit cards, as well as personal loans, which is a good outlook.
So when you see the market throw a big fit like we saw yesterday on worries that maybe they're not pricing the recession as much as, say, the bond market, what do you think? It doesn't sound like you're seeing any kind of big red flags.
Well, I'd say two things. One, we do have a higher income customer, and they also are higher in credit, so they're not going to be fully representative of the broader market. A subprime customer would be experiencing different trends, and even middle America would be experiencing different trends. But I do believe what we're seeing is a piece of the puzzle. If we don't see Fed action of 25 to 50 basis point cuts, then the concerns on the macroeconomic front will become a reality, and we will go into a recession. But I think the Fed understands the importance of the cuts that are coming. I hope they move with 50 basis points. It gives them more optionality. It'll be more impactful to corporate America, and it will definitely be more impactful for the consumer. And I think waiting to move that amount could be taking more risk than is necessary, given where unemployment is trending and given where we're seeing things like Jolt's report today.
So pretty much what you would expect from Noto. He was confident there. I liked what he had to say. I think he believes that the overall lending business is going to increase in a world in which we lower rates. I do agree with Doug in the chat here that he's not talking about technicists or small businesses or, any sort of financial component to Galileo, the technology part of their business. I think the market has kind of given up on SoFi's tech moat for now until they reaccelerate growth. And until they do that, I'm also, I mean, it's just not a tech company to me, even if it's growing at 22%. Now, granted, when they can reaccelerate that growth, I think it gets very excited. But even the biggest of SoFi bulls will tell you, like, hey, we're just not getting enough clarity on what's going on with Galileo and Technesis. So for now, SoFi is absolutely a bank. It's a bank. It has lending. That's why Noto desperately wants these rate cuts, because those rate cuts are going to help their lending business dramatically. I think that gets SoFi closer to $9 at the end of the year. I don't think it's crazy to ask for $9 if they end up doing it. Some people say its fair value is 15 right now. I think those people think it's a tech company. And the problem is, if you think it's a tech company, they're not showing that much type of tech company analysis or tech company growth. So if you still value it at $15, that means its price to tangible book is more expensive than Goldman Sachs, JP Morgan, Bank of America, Citi, Wells Fargo, etc. Right? So I think it's hard to get to that double on SoFi right here from 7 to 15. I don't think it's impossible. I just think it's hard without the tech side of the business. But I think from 7 to 10, even 7 to 11 is not crazy. Or it's at $8 right now, 8 to 12, whatever it is, because the lending business is going to grow dramatically. And if that lending business grows dramatically, then if you get the rate cuts, then I think their guidance should be good. I think the profitability should be good. And I think SoFi has a little bit more fair value attached to it. But we'll see. We'll see if that happens. If that doesn't happen, then obviously, SoFi is going to end up continuing to be at the levels that it's at right now. Where is SoFi after the bell? 749. Okay, so basically it was down 0.5% today, a little bit flat after hours, nothing too crazy. Palantir recovering a little bit. It was down about 0.5%. Now it's down 0.29%. C3 AI down 16%. Still down. I wonder if they'll say anything on the earnings call. I also wonder what clients are buying C3 AI. Like if it's a question between Palantir, C3 AI, or maybe Microsoft, like why would you buy C3 AI? So I don't know. Maybe their sales force is like getting really good deals or something to make themselves attractive. I know they were pitching themselves as one point as a cheaper version of Palantir. The problem is, if you're a cheap version of Palantir, you're probably a crappier version. And then also your revenue growth is not going to show the type of revenue growth that Palantir is doing, because you're just not making that much money per client. Volume on this thing today was 13 million. So still a decent amount of people trading this stock. Shares outstanding about 126 million for C3 AI. Vibop says 50 bips is super bearish in my opinion. That literally means the Fed thinks we are going into recession because of unemployment data. So I agree 100%. The problem is on Friday, this is the nuance, right? On Friday, if we get really good, or not really good, but like generally decent unemployment data, meaning we're adding 200,000 jobs, maybe the federal unemployment rate goes down from 4.3 to 4.2. Is that the worst thing in the world? Because at that point, the Fed's just catching up to not letting the labor market collapse. And it's literally not collapsing because the numbers we're getting on the jobs numbers are way above expectations. So I think Friday, the market's going to have to figure out, do they think if it's way above expectations, we're still going to collapse? Do they think if it's way below expectations and the Fed cuts by 50, then we're into a recession? Do they think 25 is the Fed moving too slow, even if we have a ton of jobs and unemployment goes down? If unemployment goes up and we only do 25, do they think, well, how the hell are you only cutting by 25 if the federal funds rate is only 5%, but unemployment goes from 4.3 to 4.4 or even 4.5? Like, I think all of this stuff is going to happen at 8:30 on Friday, as soon as that number comes out. And we're just going to see a very volatile stock market. And hopefully that volatility goes to the upside versus the downside. But the Fed's going to have to figure out, and the market's going to have to figure out what happens. Tomorrow is jobless claims. That's less important. I mean, that's important, but it's not like the Friday numbers. That'll probably come in the same way it's been coming in on a slight beat every week. At least over the past 2 weeks, that's how it's been. But yeah, we're going to have to wait for Friday numbers to really see what it plays out to be. Okay, let's listen to Dan Niles on Meta. Again, he's been a little bit more bearish on NVIDIA, so let's get his perspective on some of the other Mag 7, and then we'll keep going from there.
From here, and is it time to look beyond the Mag 7? Joining us this morning is Niles Investment Management founder and portfolio manager Dan Niles. Dan, great to see you. I want to spend every possible second talking about selection here, and so I wonder, as you look at the Mag 7, who you think is performing the best and the worst?
You have to go back to earnings, which I'm a fundamental investor at heart, so that's where I default back to. And if you think about the earnings season, and we first posted about this on July 11th, where we said, look, there's a rising mismatch between the amount spent on AI infrastructure and the revenues being generated. So if you look at the big three hyperscalers, Microsoft, Amazon, and Google, all three of those companies had forward revenue estimates get cut after they reported, despite increasing the amount that they were spending on AI. So where did the numbers go up? Well, Meta is actually using AI the best to run their business. They beat revenues and EPS in the quarter. They had forward revenues and EPS estimates go up despite spending more on AI infrastructure. And it's trading at a reasonable valuation where the S&P is at a pretty high 23 times, but Meta's only trading at 24 times, even though it's growing much faster than the S&P companies. The second one is Apple, because Apple actually, for a change, beat revenues and EPS in the quarter and had forward revenues and EPS go up. Now, obviously, the last 3 years have been terrible for growth in the sense of, if you look at the fundamentals, revenues grew 2% 2 years ago. They didn't grow at all last year. And this year, it's only growing 4%. And they've benefited tremendously from multiple expansion, which is the one thing I don't like about the company, is it's trading at 33 times versus the S&P at 23. But having said that, I think for the first time since COVID, which was 4 years ago, you're going to have investors say, you know what, I upgraded my phone 4 years ago during COVID because I needed to. Now I've got these new AI features. They will only run on iPhone 15 Pro or later. You have a 1.2 billion installed base, and less than 10% of those phones can run the new AI features called Apple Intelligence. And so I think with Apple, it's really probably the only Mag 7 name where I see revenue growth accelerating, albeit obviously it's from pretty pitiful levels. But still, I think you're going to see it go up from 4% revenue growth this year to closer to 10% growth as you get into next year. And so those are the two that I would stick with. And obviously, to round this out, Tesla's got a lot of competition challenges, very high PE. It's hard to give them credit for full self-driving and robots and all the other wonderful things they have in the pipeline when it's this expensive. And then with NVIDIA, we've been saying this again since, I think, July 11th. If you believe there's an AI CapEx digestion phase, that stock's going to have a near-term problem, even though over the next several years, we think revenues can double again, and so can the stock.
Is there a level that would entice you on NVIDIA? A lot of people looking at 100 as a key support level there.
Yeah, I mean, I think, Sarah, you bring up a good point. I mean, even if you go back to when the tech bubble broke, so the ultimate disaster for tech investors where NASDAQ went down 78% over 2.5 years, you had a lot of breathtaking rallies within that drop. So with NVIDIA, we were negative going into earnings. We looked at yesterday and said, wow, it's down 9% or so with no news. Became a lot less negative, and I have to admit this morning was thinking about, well, hey, do I get another rally because just investors want to believe that this is going to do well? And so could you get a short-term bounce before you start going lower again? And so that's definitely something we're thinking about, because at 40 times earnings, most investors are not, in my view, they're not believing that there's a CapEx digestion phase. They believe it's going to continue for a long period of time because you've got a lot of companies saying that, hey, the risk is underinvesting, not overinvesting, which to me says they know they're overinvesting. And at a certain point, revenues don't catch up. There's a problem. But sure, in the near term, at these, you get down to that 100 level, I think you buy it for a bounce. And, that's kind of the way we play a lot of these names because they are so volatile. So great point on your part.
It's interesting. Once you have a narrative, you kind of got to stick to that narrative. And his narrative, these are the headlines right here. So 23 hours ago, NVIDIA gets a DOJ subpoena and escalating antitrust probe. 36 minutes ago from CNBC, NVIDIA says they didn't receive an antitrust subpoena. If your narrative is there's a CapEx digestion phase and all the big hyperscalers are going to stop spending money, then you believe NVIDIA is going to collapse soon. If your narrative is the opposite of that, you believe NVIDIA is going to do fine. It seems like, Dan and other analysts have come to the conclusion that they're going to stop spending relatively soon, which if you believe that, yeah, you got to be bearish. From what the guidance NVIDIA is giving us and also what the big tech companies are saying, and then if you just look at some of the anecdotal evidence, it doesn't look like they're stopping soon. One day they will stop. I think that's closer to 2026, end of 2025. I don't think that's next quarter. It's definitely not next quarter. We know based on NVIDIA's guidance. And by the way, you'll know before it happens. Like NVIDIA will give guidance one quarter, and that guidance will be so egregious that it'll be obvious that Google, Amazon, Microsoft are not spending that much. Unless NVIDIA expanded their clientele base beyond the hyperscalers to the point where they can still put up crazy numbers, which would be an amazing dip opportunity for people to buy the dip. So they would still put up like $40 billion one random quarter, even though Amazon's not spending $20 billion anymore because NVIDIA got some other clients, maybe it's governments, whatever it may be, to pay that much money. But we should theoretically know if there's going to be a CapEx slowdown based on that guidance. And from what we saw in Q3, and then Blackwell starting in Q4, and then Jose on the channel today, he said most of the hyperscalers have to keep upgrading the infrastructure to be able to be competitive, especially if Blackwell and other types of chips that NVIDIA has continues to compound in terms of their efficiencies and effectiveness. You would imagine CapEx is not going away that soon. Now, if we get into a recession, everything's off the table because all these CapEx, all these hyperscalers are going to, protect their core business. They're not going to be spending $20 billion a quarter just on chips, which is why that jobs report on Friday is so important. But if we avoid a recession, then it looks like the hyperscalers are going to keep spending money. And if they're going to keep spending money, then it doesn't look like NVIDIA is going to be in that tough of a situation. But we'll see. It really depends. It really depends on that one metric, and obviously really depends on this jobs report that we got on Friday. And that's pretty much it. C3 AI down 16%. SoFi up a little bit. NVIDIA up a little bit after hours. S&P is flat. All in all, I mean, I know we went from green to red, but I mean, I think a lot of people, like we were 554 on the S&P. We're at 550. A lot of people thought we would hit 540s today. A lot of people thought the NASDAQ would hit 430, 445. Like we thought we would get an egregious 3 to 4% compounded sell-off from yesterday. That didn't happen. Maybe that happens later in the month, but at least for today, the market chilled out and they were like, you know what? We don't think it makes sense to sell some of these equities and we're going to just buy the dip. And on a lot of these names, the dip ended up getting bought. Now, again, individual equities like Celsius took a little bit of a hit. Dollar Tree took a bit of a hit, but then a lot of that money rotated into companies like Tesla that showed off new features. And the market got kind of excited for what's going to happen and probably what that 10-10 event ultimately will do for Tesla. All right. I think that is it, folks. Oh, the other thing I forgot to mention, the 10-year and the 2-year inverted. The 10-year and the 2-year inverted. Did they close inverted? Let's see right now. 10-year, 2-year spread. I think it closed positive. That's a hell of a adjustment on these bonds. 2 years giving you 3.76. 10 years giving you 3.75. Okay, so this 2 years still paying you a little bit more, but the spread is very, very narrow. Sorry, uninverted. Sorry, I meant to say uninverted. So still inverted, but the spread is narrow, negative 0.01. Again, the 10-year, you're getting 3.757, just a little bit less than the 2-year at 3.77. It's 3.766. I mean, we're talking literally negative 0.1 determines the width of those spreads. And again, you want to see this inversion. Oh, I forgot to show the other chart I was going to show. Hold on. There was another chart I needed to show. This 10-year, 2-year thing just reminded me. This was one of the big charts I want to show. So whoever stick till the end, congrats, because this is the chart that I want to show. This is not necessarily super bullish. It's also not super bearish, but it is a trend to look at. All right. So Nick from the Wall Street Journal, this is what he posted. So these are 3 charts about what happens historically when the 10-year yield rises above the 2-year yield, AKA they uninvert after they were inverted. Again, when they invert, you get a recession. That it really hasn't happened over the past 2 years. When they uninvert, historically, this is what happens. Maybe this is not what maybe this doesn't happen again because the recession didn't happen so far from the inversion over the past 2 years. So S&P 500, July 1998, after the uninversion, which is this line, this perpendicular line right here, perpendicular angle. You guys like that word, right? Perpendicular. That's a hell of a dude. I haven't used that word since fucking 9th grade. Perpendicular. That's the reason I like that word. So July 1998, you see markets went up. There's the blue line. Markets went up after the uninversion. June 2007, markets collapsed. December 2000, markets collapsed. So historically, there is one moment when the S&P actually goes up after the uninversion, and that is July 1998. Now, what is Dan Ives and Tom Lieben saying? Hey, we think it's 1995 to 1999, not 1999 to 2001. This would be the best time for that 1995 to 1999 thesis to play out, because we literally need a 1998 moment in terms of the uninversioned reaction by the broader S&P 500 in order to keep this bull market alive. If we don't get there, then we have June 2007 and December 2000. Oh, sorry, December 2000. I said December 2020. December 2000. We basically have 2 cycles where we lead into a recession. So we really, really, really do need July 1998 to happen. So for every time you heard Dan Ives saying we're in 1998, 1999, we better be there, because historically, if not, then June 2007 and December 2000 looks a little bit more likely. Here's another chart. So this is payroll growth, the 3-month average after the uninversion of the yield curve. As you can see, July 1998 stays pretty stable at about 200,000 jobs, 290,000 jobs a month. June and December 2000, June 2007, December 2000, it collapses. It collapses. And then finally, right here, the change in the federal funds rate before and after the Treasury yield curve uninverts. You have July 1998 kind of stays stable. June 2007 collapses. December 2000 collapses as well. You're saying 1998, I think, is when it reinverted. Interesting. Okay, so that might actually explain. Thank you for putting that in the chat. That might explain why 1998 was so good. So if 1998, if we reinverted, maybe that's the reason we were not June 2007 and December 2000 on the S&P 500. That also explains why interest rates probably didn't continue to come down as well. Now here's the thing. I mean, we technically reinverted this morning. We had an intra reversion this morning. We uninverted for like 20 minutes and then we reinverted. So historically, this is why it gets so nuanced and like weird to look at historical precedents. If in 1998 we had a reversion, which I think you guys are correct about, 1998 we had a reversion of the uninversion, and that's why we stayed afloat, which is weird because theoretically you're not supposed to have that be the case in terms of like avoiding a recession. Then the only other times where we uninverted and we had a massive collapse was June 2007 and December 2000, which is not good. Again, this was not the most bullish data. I was counting on 1998 to be bullish, but now if you're telling me we had a reinversion in 1998, well, never mind, folks. 1990, maybe we need a reinversion instead. Maybe we need a reinversion instead. So in 1998, the max inversion was -5 basis points, and then it reinverted. Interesting. So again, but the thing is, I don't even know if this is like the best metric, because we haven't had a recession in 2023, 2024 so far, because based on the inversion, right? The yield curve's inverted early 2023, haven't had the recession so far. Maybe it happens in 2024. So that metric, you could argue, is not even that good of a metric. So then the opposite of that metric, which is the uninversion, is that a signal for if we get out of a recession and if payroll growth is okay and the broader economy can hold up? I don't know. Can it? Can it not? Like, I think there's so much nuance to this sort of congruent argument around uninversion or reversion. But then again, you could say that none of that stuff matters, because historically in 1998, it didn't line up with the odds. And over the past 2 years, we didn't get that recession that everyone was promised for. Remember, this is why Tom Lee and Dan Ives made their name. In 2023, every sophisticated Wall Street analyst said, hey, we are going to get a recession because the yield curve is obviously inverting. And because it's inverting, we need to be able to use that as a key economic indicator for a recession. It didn't happen. So the Mike Wilsons of the world, the Mario, I think his last name is Klagvonichik or something from Morgan Stanley or JP Morgan, the Julian Emanuel, right? These guys, the guy who flipped bullish a couple months ago, like all these people said recession, and it didn't happen. Whereas Tom Lee and Dan Ives were like, no, there's going to be no recession because you got to look at tech. So Dan Ives and Tom Lee were on the tech side. The finance guys were on the yield curve inversion historical economic indicator side. And now, going into the next 4 months, one of those camps is going to end out the year right. Either tech And the AI thematic and earnings growth is going to be so strong that the uninversion/reversion of the yield curve is not going to match what happened in 2008, 2007, or 2000. And it's just going to be a bull market based on earnings growth. Or it's going to be the guys in 2023 that said, hey, a recession is inevitably going to come. And then you get the recession. It was just they were 2 years early. It's really going to be one or the other. It's going to be one or the other. I'm hoping it's Dan Ives and Tom Lee. I think that's what gets us the bull market. But it might not be any of them either, too, dude. Like, we have no idea how this next 4 months play out. You might just have a flat market that doesn't do anything, doesn't go up, doesn't go down, doesn't care about jobs, doesn't care about non-farm payrolls, doesn't care about uninversion of the yield curve. Like, I think there is so much nuance here. We still have a lot of money that we printed. We have a lot of money on the sidelines and money market funds. There's a lot of variables here. And I think those variables ultimately are going to have some impact, but no clue what the impact is going to be over the next 4 months. What if I told you you're in the stock market matrix? You know what? It does feel like that. It absolutely does feel like that. So, I mean, yeah, either look, you agree with kind of these historical precedences that it happened in 1998 or 2007, 2000, or you disagree. And I guess we'll find out over the next coming months. Lee says AI productivity will boom and that'll lead to higher profits and lower employment at first. I agree. The question is going to be if you're right about the first part, Lee, which is AI productivity boom. I think that's definitely going to happen. I'm pretty convinced about that stuff based on the data that I'm looking at. But if that doesn't happen, then the whole narrative falls apart. So again, like, theoretically, job growth should be increasing, or even if job growth is not increasing, job productivity, which Bank of America put out a good study a couple months ago. They said, hey, we're more productive than we've ever been since 2008 in terms of the levels that we're at. That should increase GDP, even if job growth is not increasing. But then the counterfactual to that is, well, what if that increases GDP so much, or sorry, not GDP, productivity so much, where if you're in a company and you implement AI and that is technically replacing the job of a couple other 100 people, and you no longer need them, your obligation is to shareholders to increase operating margins, and you fire those people. Well, you just fired a bunch of people, and that hurts GDP growth. That potentially hurts productivity. That potentially hurts the labor market. So I think there's going to be a lot of different ways that we have to navigate this over the next few months, definitely next few years. But so far, I think the jury's out in terms of how this is going to play out. Where's NVIDIA after hours? Is it getting a little bit of love on this DOJ stuff? Wow, yeah, it's up 1%. I mean, again, 1% is a decent. That's like closing in on $10-15 billion of market cap on NVIDIA, just on that 1%. And that 1% might be because the DOJ never subpoenaed NVIDIA, which is that's pretty insane if that's the reason it sold off yesterday. NVIDIA right there, up about 1%, 106.98. Now it's at 107. SoFi up a little bit. C3 AI still down 16%. Palantir down about 0.2. QQQ green after hours, but probably because of NVIDIA. Affirm is green. Bitcoin, 58,000 as well. Tesla green at 220 or 219.41. AMD up a little bit. Intel at 1952. SMCI at 423. And then Robinhood, 1908. S&P 500. Wait, where's Palantir? Palantir 30.59, 30.53 after hours, and then S&P 500 550.73. Basically flat after hours. All right. There you go. That is pretty much it. If that news is not real, it's going to be really funny. It's going to be, dude, there's a lot of, I mean, there's not that much liquidity after hours, but in the market open tomorrow, if the broader market thinks that news was completely fake and they sold off NVIDIA for no reason, that is going to be really funny. It's going to be really funny to see how the market ultimately interacts with that. So much news, dude. There's so much going on, so much stuff to track. But we got to cover all of it. All right. So tomorrow is jobless claims data. That's the big thing tomorrow morning. That's pretty much it in terms of big macro data. I'll just confirm that right now. We get money market fund data tomorrow. So we'll see if companies and people are still piling into money market funds. Do we get retail sales? No, that's for a different country. We get services PMI. We get oil imports. That'll be interesting given oil prices have been low. We have a 4-week and 8-week bill auction. Canada, by the way, I found out some new news about Canada. Apparently, the new Democratic Party was going to sign a bill with the Liberal Party, Justin Trudeau, and the new Democratic Party, this guy named Jaspreet Singh, I think that's his name. He basically stabbed Trudeau in the back and said, actually, you're a corporatist. You're not a leftist. So we're leaving you. And he's now running for prime minister. And now you got the Canadians dealing with all this stuff going on because you had a liberal part of the country united, and now they're not united. Kind of feels like when Clinton went against Bernie Sanders in 2016. Kind of feels like a little bit of that going on. My analysis is probably not the best on this because I'm not Canadian, but that happened this morning after the Bank of Canada cut rates by 25 bips. And so you've just got all this different geopolitical stuff, political turmoil going on. We've got the debate coming up in a week. And then obviously the United States election. And then that'll implicate kind of where the trajectory of the market goes. But the biggest thing, yeah, that tomorrow, that's the only thing. Jobless claims and ISM, a little bit of ISM. Outside of that, with money market funds, Friday, the jobs data. That's it. That's what we got to wake up for. That's what we got to look forward to. And that jobs data is gonna be pretty much everything we have to look at. Oh, Broadcom's tomorrow as well. All right, so tomorrow after the bell, Broadcom. So we'll do Broadcom, and then we'll have Jason join tomorrow, and we'll do Technical Thursday, and keep going from there. Did you ever do the Sham TechCrunch? You know, I haven't had a chance to read it yet. I literally have not. I'll probably read it today and do a video on that pretty soon. But I haven't had a chance to read that yet. I've read like snippets of it, but I haven't sat down and actually read it. But for those that don't know what I'm talking about, I can link it right now. This was a piece that I did read his Axios article that came out 2 weeks ago. So he's been doing a lot more press. But this is the Sham Sankar article for those that haven't read it yet from TechCrunch. We'll probably do a video on that later this week. All right, that's it for me, folks. Thank you all for joining. Again, thank you for 40,000 subscribers. It means the absolute world to me. Really, really appreciate it. And it is a nice milestone. Now we just got to keep working, keep grinding, keep doing what we got to do. But thank you for spending your time with me in the morning and in the afternoon. For those that join in the afternoon, we got a big week coming up with tomorrow, jobless claims, Broadcom earnings, and then Friday on that jobs report. And then we'll see what happens. Next week is going to be really exciting. I can't tell you what's happening next week, but next week's going to be really fun. And that's all I'll say. Next week, I'm going to be traveling a little bit. So September, second week of September, it'll be a fun week. And you guys will get some new content as well. All right. Thank you, everybody. Have a good one. Appreciate it. I will see you guys tomorrow, 8:45 on the Market Open. Bye, everyone. Have a good one.